Hello there, future chartered accountants. Welcome. Today, we're diving into a chapter that is the absolute bedrock of auditing, risk assessment and internal control. Look, this isn't just about memorizing theory. We're going to build the fundamental mindset you need to think like a real auditor.
But hang on, before we jump in, let me ask you something. What is the number one trap that ICAI sets in exam questions about audit risk? It's a surprisingly simple idea, but the way they twist it is exactly how they catch students out and cost them easy marks. Stick with me, because by the end of this, you'll spot that trap a mile away and never fall for it. So, to get our heads in the game, let's look at a quick scenario. Imagine Samir, a student just like you. He's reading the news and sees that SEBI is investigating a company after the audit report was signed and published. And he's just sitting there thinking, wait a second, how does that even happen? How can a professional audit go so wrong? That question right there gets us to the heart of today's topic. What is an auditor's absolute biggest fear? So what is that one thing that keeps auditors up at night? Well, it has a name. It's called audit risk. And trust me, this is the shadow that looms over every single audit engagement. So what does that mean in plain English? It's the risk of being wrong. It's the risk that you, the auditor, sign off and say, everything looks great, clean opinion, when, in reality, the financial statements are hiding a major error. This is the risk that leads to those nightmare headlines that Samir was reading about.
Okay, now let's get technical. This formula you see on screen, it's your foundation. You absolutely have to know this by heart. Audit risk is basically made up of two things multiplied together: the risk of material misstatement, which we call RMM, and detection risk, or DR. Let's break down what each of these really means. First up, we've got RMM. Now, listen carefully, because this is the most important part. This is the client's risk. It's the risk that their books are already messed up before you, the auditor, even start your work. It has nothing to do with you. This risk exists inside the company itself. So what does this kind of misstatement look like? Well, it could be a simple mistake, like booking a new piece of machinery as an expense instead of an asset, or it could be something much more sinister, like deliberately creating fake invoices to lower the company's profit. Or maybe it's just laziness, like not writing off debts from customers you know are never going to pay. All of these are problems that originate within the company. And this risk, this RMM, can show up in two ways. It can be at the overall financial statement level. This is a big, pervasive problem that affects everything. A classic example is a going concern issue. If the company is about to go bankrupt, that casts a dark cloud over the entire set of financial statements. On the other hand, the risk can be at the assertion level. This is much more specific. It's a risk tied to a single transaction type or account balance, like the company is using the wrong method to value its inventory. Now, let's go one level deeper, because RMM itself has two parts. The first is inherent risk. This is the raw, natural riskiness of something, assuming the company has zero controls in place. For your exams, whenever you see a complex financial instrument or a business in a brand new risky industry, like that wear and tear startup example from the ICI material, your brain should scream inherent risk. The second part is control risk. This is the risk that even if the company has controls, like a manager who's supposed to review invoices, that control fails and doesn't catch the error. All right, now for the other half of our big formula, detection risk, or DR. This one is all about you, the auditor. This is the risk that your audit tests, your checking, your analysis, will fail to find a big misstatement that's actually sitting right there in the client's books. And here's the kicker: this is the only part of the entire audit risk model that the auditor can actually control. And this slide right here, this is the answer to the question I asked at the very beginning. This is the ICAI trap. This is where students lose marks. There is a fundamental, inverse relationship between RMM and detection risk. Think of it like a seesaw. If the client's risk, the RMM, is super high, you, the auditor, cannot afford to have a high risk of missing something. So your detection risk has to be set low. And how do you make your risk of missing something low? You do more work, more checking, more testing, more procedures. On the flip side, if the client is low risk, you can accept a slightly higher chance of missing something, which means you can do a bit less work. ICAI loves to give you a high RMM and ask about detection risk. The answer is always low. Get this relationship right, and you've got this. So take a look at the quote on the screen. This thinking, this is pulled straight from an ICAI illustration. And you know, it almost sounds logical, doesn't it? Hey, I've done this a dozen times. I know my stuff. But here's the thing. In auditing, that assumption is just plain wrong.
Every single company is different, and thinking they're all the same, that's the first step to a pretty bad audit. Well, the answer comes from our very own, let's call it an audit GPS. It's Standard on Auditing 315, or SA 315. Now, the full name is a bit of a mouthful, identifying and assessing the risks of material misstatement and so on, but just think of it like this. It's not just a suggestion, it's your mandatory roadmap for the entire audit. All right, understanding the entity's world. This is really the heart of SA 315. It's all about putting on your detective hat and getting to know everything about the company, what's going on outside its doors, and what's happening inside too. AS 315 gives us this really clear 4-step blueprint to follow. First up, we look at external factors. Then we dig into the nature of the entity itself. Third, we check out their accounting policies. And finally, we understand their objectives and strategies. So let's break each one of these down. Okay, so step 1 is external factors. Just think of this as the world the company operates in. You need to understand its industry. Is it super competitive? Is technology changing all the time? Then there's the whole regulatory side of things. What laws, taxes, or accounting rules do they have to follow? And of course, you've got the bigger picture stuff like the economy, inflation, interest rates, all of it, because any of these can create risks in the financial statements. Next up, step 2, the nature of the entity. So now we're looking inside. How do they actually operate? Who owns the company and who's in charge? What are they investing in? How are they structured and financed? And hey, listen up, because this is a huge exam tip. Understanding the ownership and structure, that's your number one way to sniff out related party transactions. Complex structures should be a giant red flag for you because that's often where the hidden problems are. All right, step 3 is all about their accounting policies. Your job here is pretty straightforward. You're asking 2 key questions. First, are the policies they're using a good fit for their specific business? And second, do those policies line up with the official rules, like Ind AS, and what's normal for their industry? If you see something unusual, there better be a really good reason for it. And that brings us to step 4, objectives, strategies, and of course, the business risks that go with them. What's the company actually trying to do? I mean, look at the examples here. Maybe they're trying to expand, but there's a risk they get the demand all wrong. Or they launch a new product and suddenly face liability risks. The key thing for us as auditors is to connect the dots. We have to spot these business risks and ask, okay, how could this mess up the financial statements? Okay, let's make this super practical. Check out illustration 6. You've got a company, Prince Blankets, and most of their sales are online. So what? How does that one little fact, something you found out while understanding the nature of the entity, change your entire audit? Well, it changes everything. Online sales immediately scream high-risk area. You're now thinking about revenue recognition, cybersecurity, are their systems even reliable? Suddenly, your audit plan for sales looks completely different than it would for a regular brick-and-mortar store. And this is a perfect example of why this step is not optional. It literally dictates what you do next. So we've gotten a handle on the risks from the outside world and from the business itself. The next logical step then is to look inside the company. How do they actually manage all these risks? And that brings us right to section 3, internal controls. So what exactly is internal control? Well, you can see the official definition from SA 315 right there, but let's break it down. In simple terms, it's everything the management team does to keep the company on the right track. It's the whole system they build to make sure their financial reports are reliable, their operations are running smoothly, and they're following the law. And it's not a set it and forget it kind of thing, it's an ongoing process. Now, this next part is a really, really important exam topic, so pay close attention. Internal control isn't just one big thing. It's actually a system made up of 5 connected components. First, you've got the control environment. That's the foundation, the tone at the top for management. Then there's the company's own risk assessment process. Next is the information system. You know how all the data gets handled. Fourth, you have the specific control activities, things like getting approvals or doing bank recs. And finally, there's monitoring of controls, which is just making sure the whole system is working like it should. Let's zoom in on that risk assessment process for a second. This is all about how the company handles its own risks. They should have a system in place to do 4 things. 1, identify their business risks. 2, figure out how big of a deal those risks are. 3, guess the likelihood of them actually happening. And 4, decide what to do about them. Our job as auditors is to check out this process. Because hey, if the company is good at managing its own risks, that makes our life a little easier. Okay, time for a quick test your understanding. Let's say an auditor, CA Smriti, is checking for segregation of duties. She's making sure that, for example, the person who authorizes a payment isn't the same person who records it. So, which of the 5 components is she testing? It's control activities. And why is this so incredibly important? Well, because segregation of duties is one of the absolute best ways to prevent fraud. I mean, think about it. If one person can do everything, what's to stop them from paying themselves and covering it up?
All right, so we've understood the entity, we've looked at its controls, but why did we do all that work? Well, it all leads up to this next step, spotting the risks. And even more important than that, spotting these significant risks. These are the big ones, the ones that should really get your attention as an auditor. So what makes a risk jump from just a risk to a significant risk? Well, SA 315 gives us a handy checklist. A risk is usually significant if it involves fraud, for starters, or if it's tied to big recent changes in the economy or accounting standards. Other triggers, really complex transactions, major deals with related parties, anything that needs a lot of subjective guesswork like a complex estimate, and finally, any big transactions that are just weird or unusual for the business. And a really key idea here is the difference between routine and non-routine transactions. Think about it. Routine stuff, like daily sales at a grocery store, is predictable, often automated, and happens all the time. Lower risk. But non-routine transactions, like selling off a whole division of the company, that's a one-off. It's unusual, infrequent, and it involves a ton of manual work and management decisions. That's where the risk is much, much higher. Your significant risks, they love to hide in those non-routine areas. Okay, everyone, listen up. Exam alert. This is one of those non-negotiable points you just have to know. The risk of material misstatement due to fraud is always treated as a significant risk. Always. No ifs, ands, or buts. You don't get to think about it or decide. The standard says it is, so it is. You gotta remember that. And here's the second exam alert. It's another always rule. The risk that comes from significant related party transactions that are outside the normal course of business, that is also, you guessed it, always a significant risk. Again, no debate. The ICAI absolutely loves to test these 2 automatic ones. So lock them in your brain. Fraud and weird related party deals. Both are always significant. All right, so an auditor might find hundreds of tiny errors. Do they have to worry about every single one? No way. They need a filter to separate what matters from what doesn't. That filter has a name, materiality. It's covered in SA 320, and it basically helps us answer the question, so what? Does this error actually matter? So the official definition is all about the users of the financial statements. Think investors, banks, creditors. An error is material if it's big enough or important enough that it could change their decision about the company. The key thing here is that it's a matter of professional judgment. You know, a 5 lakh rupee error might be completely irrelevant to a giant company like Reliance, but it could be a company killer for a small startup. Context is everything. Okay, I know what you're thinking. If it's all about judgment, how do we turn this into a real number that we can actually use during the audit? Well, there's a method to the madness. Let's look at how we actually calculate it. What auditors do is they pick a benchmark from the financial statements and then apply a percentage to it. But which benchmark do you pick? Well, you have to think about a few things. What are the most important numbers for this company? What do investors really focus on? Is it a manufacturing company where assets are key, or a tech company where revenue growth is everything? The industry, the ownership, it all plays a role. Now, some of the most common benchmarks you'll see are profit before tax, total revenue, or total equity. And to figure out the number, you'll look at things like last year's figures or this year's budget. But here is a massive exam tip for you. For most normal profit-making companies, the go-to most common benchmark is profit before tax. Remember that one. It comes up a lot. But wait, it's not always about the size of the number. Sometimes a tiny amount can be hugely important simply because of what it is. This is a concept called materiality by nature, and this is another favorite area for ICKI to ask tricky questions. So you might need to set a way lower materiality level for certain sensitive parts of the accounts. For example, any transaction with a related party, like the director's brother, is considered sensitive, no matter how small the amount is. Or think about a pharma company. Their R&D spend is a critical number for investors, so even a small error there could be material. It's all about what users are paying close attention to. Okay, everyone, pens out. This is a rule you just have to memorize. It's a direct requirement from the Companies Act, Schedule 3.
It says that any single item of income or expenditure that is more than 1% of the revenue from operations or 1 lakh rupees, whichever of those two is higher, must be shown as a separate line item. This isn't judgment, it's the law. Remember those numbers, 1% and 1 lakh rupees.
And here's one more perfect example of materiality by law. A company must disclose the name of any shareholder who owns more than 5% of the shares. It does not matter what the value of those shares is, just the fact that one person or entity has that level of ownership is by its very nature material information that other people need to know. The law says it matters, so it matters.
You know, under exam pressure, a ton of students get this wrong. Take a second. What do you think? Yes or no? We'll circle back to the correct answer at the very end.
To make this all feel real, let's build our entire discussion around this one simple scenario. Imagine you're told the client has strong controls. I mean, that sounds fantastic, right? But what does that actually mean for your audit? What's your first step? Your second? We're going to use this scenario to map out the entire process, step by step.
All right, first things first. Before you can test a single control, you have to understand the system itself. I mean, it makes sense, right? You need a clear picture of what controls are supposed to be in place. This whole first part is just about gaining that understanding.
The first method for doing this is what we call a narrative record. The best way to think of it is you're basically writing a story. The auditor observes a process, say the journey from a sales order all the way to cash coming in, and writes a really detailed step-by-step description of everything that happens, pointing out the controls at each stage.
Now, of course, ICI won't just ask you for a dry definition. No, they'll give you a scenario just like this one. We've got a small business, and the auditor creates a whole description of the control system. So what method are they using here?
Exactly, it's a narrative record. And here's the crucial exam tip you need to write down. The fact that it's a small business is the huge clue. This method is pretty much perfect for smaller companies with straightforward systems, but trust me, it can get way too complicated for big, complex corporations.
Okay, our second method is the Internal Control Questionnaire, or ICQ. This is a much more structured approach. Think of it like a pre-designed checklist of questions for different areas like sales or payroll. The clever part here is that the questions are usually framed so that a no answer immediately waves a big red flag about a potential weakness.
Let's look at another ICI-style scenario. The key things to notice here are that employees are answering questions, and then there's a discussion with the auditors. Which method does that immediately make you think of?
Yep, this is a textbook example of using an internal control questionnaire. And that follow-up discussion, that is a critical piece of the puzzle. Just getting the yes or no answers is only step one. The real understanding comes when the auditor actually talks about those answers with the staff to get the full story.
And finally, we have the flowchart. As the name suggests, this is the most visual of all the methods. Instead of writing paragraphs or filling out checklists, the auditor creates a diagram that literally maps out the entire flow of documents and information using standard symbols to show every single step, document, and control check.
You know, the real power of a flowchart is this incredible bird's-eye view it gives you. It's so concise. On just a single page, you can instantly trace the journey of, say, a purchase order, see every single approval point, and spot potential problems or control weaknesses. It makes finding issues in the transaction flow way, way easier. Now for the next logical step. So far, all we've done is document the system's design. You know, how management says it's supposed to work. But as auditors, our job is to verify. We can't just take their word for it. We have to actually test if those controls are operating effectively out there in the real world. This slide highlights a super important distinction. And this is exactly where marks get lost in the exam. Understanding the system is about its design. What is the control? Testing this system is all about its operating effectiveness. Does the control actually work like it's supposed to? These are two totally separate but very closely related activities. So, how do we check that operating effectiveness? Well, we perform what are called tests of controls. These are the specific procedures we use to gather our evidence. The main types are inspection, inquiry and observation, reperformance, and of course, testing IT controls. Let's quickly break these down. Inspection is just examining evidence, like checking invoices to make sure they have an approval stamp. Reperformance is where you, the auditor, actually do the control yourself, like redoing a bank reconciliation from scratch. Now, pay very close attention to inquiry and observation. This is your go-to for controls that leave no paper trail, like segregation of duties. You can't inspect a document for that. You literally have to watch who is actually doing what. So this brings us to a really critical question. What happens when a control fails your test? Let's say you check 50 invoices for an approval stamp and you find 5 that are missing it. That's a control deviation. So, what's your next move?
Well, the first step isn't to panic, it's to investigate. You have to make specific inquiries to understand the why behind the failure. Was it just a simple human mistake? Did it happen when a key employee was on vacation? Or maybe during a crazy busy season when the team was totally overwhelmed? Understanding the reason for the deviation is just as important as finding it in the first place.
If these deviations are significant or they just keep happening, it points to what's called a deficiency in internal control. The definition on your screen is extremely important. ICAI expects you to know this word for word. It covers 2 situations. Either a control exists but it fails, or a necessary control is just missing completely.
As every auditor knows, if it's not documented, it wasn't done. This is especially true when you're assessing risk and controls. So let's look at exactly what the auditor is required to document in their working papers.
These 4 points right here are not optional. They are mandatory requirements under the standards on auditing. You absolutely must document the team's risk discussions, your understanding of the controls, the specific risks you've identified, and the connection between those risks and the controls. This creates a really clear audit trail of your entire thought process.
All right, we've gone through the whole process, understanding, testing, and documenting. Now let's bring it all together, tackle that question from the very beginning, and lock in the most critical points you need for your exam.
Okay, back to our opening question. Is this statement correct or incorrect? Based on everything we've just covered, the answer should be crystal clear by now.
And this illustrates the core distinction perfectly. The statement is absolutely incorrect. It is management's job to design, implement, and maintain the controls. The auditor's job is to evaluate and test that system. This is such a fundamental concept, and it's a favorite one for ICAI to test you on.
So for your final recap, here are the absolute must-knows. Number 1, understanding controls is a continuous process, not a one-time thing. 2, management, not the auditor, is responsible for the system. 3, know your 3 evaluation methods. And 4, tests of controls check both the design and the operational effectiveness of a control.
And I'll leave you with one final exam-level thought. Even if a company's controls seem absolutely perfect, can an auditor completely skip their detailed testing of account balances, what we call substantive procedures? The answer is a hard no. And you need to think about the inherent limitations of any control system, things like human error or management override, and why that means an auditor can never, ever rely 100% on controls alone. Thank you for watching, and all the best for your exams.